Inside the race for the future currency, it started quietly, far from public view. No dramatic announcement, no sudden shock, just a race unfolding behind closed doors, one that would decide who controls money in the decades to come. This story matters now because currency is no longer just paper or policy. It is code, trust, infrastructure, and power. As technology accelerates and geopolitical tensions rise, the battle to define the future of money has become one of the most important and least understood contests of our time. To see how close we are to a monetary transformation, we need to return to the moment this race truly began. It started when cracks appeared in the old system. Cross-border payments were slow. Settlement took days. Costs piled up at every step. For decades, these flaws were accepted as unavoidable. But as digital systems reshaped every other industry, money lagged behind, and innovators noticed. Private firms moved first. They built experimental payment rails, faster settlement layers, alternative currencies designed to bypass legacy infrastructure. At first, these projects were dismissed as toys. Too small, too risky, too disconnected from reality. But adoption grew quietly. Transactions increased. Communities formed. And for the first time, money began moving at the speed of the internet. That was the early reveal. Not that the old system was broken, but that it was no longer the only option. Central banks paid attention. They saw the risk immediately. If private networks defined the future of currency, governments could lose control over monetary policy itself. Stability, taxation, and financial oversight would shift into unfamiliar hands. What looked like innovation now carried existential implications. Quiet task forces formed. Research accelerated. Prototypes were built behind secure doors. Digital versions of national currencies, once unthinkable, entered serious discussion. The goal wasn't speed alone. It was relevance, survival. Meanwhile, markets reacted in fragments. Speculators rushed into digital assets. Volatility surged. Fortunes were made and lost overnight. But beneath the noise, something more important was happening. Infrastructure was being laid, standards debated, power negotiated. The race wasn't about price. It was about control. And as the world edged closer to a new monetary era, one truth became clear. The future of currency would not be decided in public. It would be decided by whoever moved fastest and made the fewest mistakes. The competition intensified as the stakes became clearer. Private innovators pushed forward with aggressive timelines, rolling out new features, expanding networks, and courting users at a pace governments couldn't easily match. Their advantage was speed. Their weakness was trust. The reveal deepened when early adopters began using these alternative systems for real commerce, not experiments, not trials. Salaries, contracts, and international payments started moving outside traditional rails. Fees dropped. Settlement times collapsed from days to seconds. For businesses operating across borders, the appeal was undeniable. But with growth came instability. Outages occurred. Hacks made headlines. Prices swung violently. The same freedom that attracted users exposed them to risk. Regulators watched closely, weighing the benefits of innovation against the threat of losing oversight entirely. Inside central banks, urgency replaced curiosity. They accelerated research into sovereign digital currencies, designing systems that could combine efficiency with stability. The challenge was immense. Digital money had to be secure, scalable, private enough for citizens, yet transparent enough for policy. Every design choice carried political consequences. The early conflict emerged when some governments moved faster than others. Pilot programs launched. Limited rollouts began. A few countries tested digital currency in control regions, linking it to welfare payments, transit systems, and public services. The results were promising and alarming. Adoption was swift. Control was absolute. Markets reacted unevenly. Some investors saw opportunity in infrastructure providers. Others feared overreach and surveillance. Public debate intensified, splitting along ideological lines. Efficiency versus freedom. Innovation versus control. The future of money had become a cultural battleground. Meanwhile, global coordination faltered. Competing standards emerged. Interoperability remained uncertain. Each major power wanted influence over the rules that would govern digital value transfer worldwide. Cooperation gave way to competition. The race was no longer theoretical. It was happening in real time. And as private networks expanded and governments pushed back, the world edged closer to a fork in the monetary road. One where choices made now would shape decades of economic behavior. The question was no longer whether money would change. It was who would decide how. The conflict reached its sharpest edge when the two worlds collided. A major economy announced new regulations targeting private digital currencies. Restrictions framed as consumer protection, but understood by everyone as a line in the sand. Markets reacted instantly. Prices plunged. Liquidity evaporated. Projects that once moved freely now face legal uncertainty overnight. Private networks pushed back. Developers accelerated decentralization. Governance structures were redesigned to resist control. Some platforms migrated jurisdictions. Others went dark. The race was no longer just about innovation. It was about survival. At the same time, central banks revealed more details of their own digital currency systems. Faster settlement, built-in compliance, direct access between citizens and the state. The promise was efficiency and stability. The cost was visibility. Every transaction could be tracked. Every rule enforced automatically. The power embedded in the design was unprecedented. The divide became impossible to ignore. On one side, programmable money controlled by institutions. On the other, permissionless systems governed by code and consensus. Both claimed to represent the future. Both carried risks no one fully understood. The tension intensified when international trade entered the equation. Pilot programs tested digital currencies for cross-border settlement, bypassing legacy systems entirely. Transactions cleared instantly. Costs collapsed. Geopolitical leverage shifted. Nations realized that whoever controlled the dominant digital currency infrastructure could reshape global trade flows without firing a single shot. Alliances formed. Standards were proposed. Competing blocs emerged, each pushing its own framework for digital money. Cooperation fractured under strategic pressure. What began as a technical evolution had become a monetary arms race. Inside financial institutions, panic mixed with opportunity. Banks scrambled to adapt, unsure whether they would be intermediaries or relics. Payment giants hedged bets across multiple systems. Funds repositioned for volatility driven not by earnings, but by regulation and adoption curves. The future of currency was no longer being debated in theory. It was being fought over in code, policy, and infrastructure. And as the battle intensified, one reality set in. Once money becomes programmable, whoever writes the rules doesn't just influence the economy, they shape behavior itself. The race was approaching its decisive moment. The climax arrived not with a single announcement, but with a realization spreading across governments, markets, and institutions at once. The future of currency would not be won by ideology alone. It would be won by adoption. One digital system crossed a critical threshold. Usage moved beyond pilots and speculation into daily life. Salaries were paid. Taxes settled. Trade cleared instantly. What mattered was no longer who designed the system, but who people trusted enough to use it at scale. Private networks learned a hard lesson. Speed without stability limited growth. Freedom without safeguards scared institutions. At the same time, state-backed digital currencies faced their own reckoning. Efficiency came with scrutiny. Control came with resistance. Citizens questioned how much visibility into their financial lives they were willing to accept. The resolution unfolded through compromise rather than conquest. Hybrid systems emerged. Private infrastructure adapted to regulatory frameworks. Governments softened rigid designs to preserve public trust. Interoperability became the new battlefield, not dominance. The future of money wasn't singular. It was layered. Banks survived by evolving. They became service providers, not gatekeepers. Payment networks transformed into settlement engines. Value moved faster, cheaper, and more visibly than ever before. And beneath it all, code replaced paperwork as the true backbone of finance. Modern relevance could not be sharper. Money is no longer just a medium of exchange. It is a system of rules, permissions, and incentives written into software. Every design choice shapes behavior. Every update shifts power. The race for the future of currency didn't end. It stabilized. And that may be the most important lesson of all. Because once money becomes programmable, the question is no longer what it can do. It's who it ultimately serves. Sometimes the smallest shift in perspective becomes the beginning of a new future. In